Gold just averaged over $5,000 an ounce for 8 consecutive months. That is the longest positive streak in recorded history. Not in the last decade, not in the last century, in the entire history of gold as a priced commodity. And almost nobody is talking about it. They should be. Because gold doesn't move like this when things are fine. Gold moves like this when the people who manage the world's money are quietly, desperately, preparing for something catastrophic. Here's what they are preparing for, and why it matters more to your bank account than anything else you will hear this year. To understand what is really happening, you need to know one number: $40 trillion. That is the current national debt of the United States. But the number alone is not the story. The story is what happens next. 34% of that debt, roughly $13.6 trillion, matures in 2026, this year. That means the United States government has to refinance, roll over, or somehow pay back $13.6 trillion in the next 9 months. Let that sink in for a moment. They cannot pay it back. That option does not exist. The only option is to borrow more money to pay off the old money. It is a credit card being used to pay another credit card. And the interest rates on the new debt are significantly higher than they were on the old debt. This is not speculation. This is the Treasury Department's own published maturity schedule. You can look it up yourself. And it creates a problem so enormous that the only realistic solution is the one they've used every single time before, and the one they are almost certainly going to use again. Quantitative easing, money printing. Whatever you want to call it, the Federal Reserve is going to have to create trillions of dollars out of thin air to absorb the debt that nobody else wants to buy at these rates. And the people who manage serious money, the central banks, the sovereign wealth funds, the family offices, they already know this. That is why they are buying gold at a pace the world has never seen. And here's where it gets really interesting. This is not just an American problem. This is a global pattern, and it has happened before. In 1979, the United States was entangled in a conflict in the Middle East. Oil prices doubled. Inflation surged. The government printed money to manage the crisis, and gold exploded, rising over 100% in a single year. Right now, in 2026, the United States is entangled in a conflict involving Iran. Oil prices have surged. Inflation is stubbornly persistent. And gold is following the exact same trajectory it followed in 1979. The chart overlay is almost identical, point for point. Smart traders are circulating this comparison everywhere, because the pattern does not just rhyme, it repeats. But this next part is the reason I made this video, because the 1979 parallel is actually the optimistic scenario. In 1979, total US national debt was $827 billion. Today, it is $40 trillion. That is a 48 times increase. In 1979, the debt-to-GDP ratio was 32%. Today, it is over 120%. In 1979, the Federal Reserve had room to raise interest rates to 20% to crush inflation. Paul Volcker did exactly that. Today, raising rates to 20% would mean the government's annual interest payments alone would exceed the entire federal budget. They cannot do it. The tool that saved us last time does not exist anymore. So they are trapped. If they keep rates high, the debt spiral accelerates and the economy contracts. If they cut rates and print money, inflation reignites and the dollar loses purchasing power even faster. There is no clean exit. There is no soft landing. There is only which kind of pain arrives first. But the central banks of the world are telling you their answer with their actions, not their words. China has been buying gold every single month for over 2 years straight. India, Turkey, Poland, Singapore, they are all stockpiling at record rates. In 2025 alone, central banks purchased over 1,000 tons of gold. That was the third consecutive year of purchases above 1,000 tons, something that had never happened before in history. Ask yourself a simple question. Why would the institutions that literally print money be converting that money into gold at the fastest rate ever recorded? They're not doing it because they think the system is stable. They're doing it because they know what is coming. Now, here's what they will tell you. They will tell you gold is a bubble. They will tell you it is overvalued. They will point to charts and say it has gone up too much, too fast, and a correction is coming. They said the same thing at $2,000. They said it at $3,000. They said it at $4,000. And gold is now over $5,000, with serious analysts projecting $7,000 to $8,000 per ounce by this summer. The reason the bubble narrative keeps failing is because gold is not going up. The dollar is going down. Gold is not rising in value. Your currency is losing it. 1 ounce of gold still buys a fine suit, just like it did 100 years ago. What has changed is that the dollars needed to buy that same ounce keep multiplying, because each dollar is worth less than it was yesterday. This is the part that affects you directly. If you have savings in a bank account earning 3 or 4% interest, and real inflation is running at 8 to 10%, you are losing purchasing power every single month. Your number goes up slightly. Your buying power goes down significantly. You are getting poorer while being told you are earning a return. The median American household has about $8,000 in savings. At current inflation rates, that $8,000 will buy what roughly $6,800 buys today. Just 12 months from now. That is a $1,200 invisible tax on the family that probably cannot afford it. And it compounds. Year after year, the savings shrink, the prices climb, and the people who understood this early, the ones buying gold and hard assets, pull further ahead. This is not a rich person problem. This is a math problem. And the math does not care about your politics, your feelings, or your faith in the system. The math says that a government $40 trillion in debt, with $13.6 trillion maturing this year, running deficits of $2 trillion annually, facing a war that is doubling energy costs, has exactly 2 options. Default, which will never happen because it would end the global financial order overnight, or inflate, which is the quiet default, the one where they pay you back in dollars that buy less than the ones they borrowed. Every central bank in the world is betting on option 2. That is why gold is at $5,000. So what does this mean for you? It means the window to protect yourself is still open, but it is closing. It does not mean panic. It does not mean sell everything and buy gold bars. It means understand that the rules of the game have changed, and the people at the top changed them without telling you. Sound money, whether that is gold, Bitcoin, or any asset with a fixed supply that no government can print into oblivion, is not a speculation anymore. It is a defense strategy. It is the difference between watching your wealth quietly evaporate over the next decade and actually keeping what you have earned. The longest gold streak in recorded history is not a market anomaly. It is a verdict. The smartest money on the planet has looked at the numbers, done the math, and decided that the current financial system cannot continue as it is. They are not waiting for permission. They are not waiting for a crash. They are moving now.